Hey there YouTube. So in this video I wanted to talk about the potential U.S. estate taxes for non-resident investors in the U.S. So a non-resident is someone who is not a U.S. citizen, not a green card holder, not someone physically in the U.S. that meets that substantial presence test. So you're living outside the U.S. but you want to invest in the U.S. market. So you want to either open a U.S. brokerage account to trade U.S. stocks or bonds, you want to invest in U.S. real estate, or maybe you want to buy an interest in like a U.S. company directly, so you want to go into an LLC or a partnership with other business partners in the U.S. If you do that and you're a non-resident, you need to be aware of these potential estate tax issues. So what is the estate tax? A lot of countries have this. An estate tax is also called a death tax, transfer tax, inheritance tax. Effectively, the government, when you die, they look at all of your gross estate, what's the value of your estate, your net assets, and they assess a tax on the fair market value of those assets. So it's not a tax on income, it's a tax on what your net worth is. Now, a lot of countries, the US included, have exemptions, right? So in the US, if you're a US citizen, your estate is only taxable if it's worth more than about $11 million, right? So if you're worth, let's say, $4 million on the day you die, you have an estate worth $4 million, but the U.S. estate tax isn't imposed because you didn't meet that $11 million threshold. Now, for non-residents, and this is what most people do not know exists, right? A lot of even tax professionals aren't cognizant of these rules. If you're a non-resident and you have U.S. situs assets, so that's U.S. stocks, bonds, U.S. real property, business holdings, you're subject to an estate tax if you die. And the exemption is only $60,000, okay? So if you're a non-resident, let's say you're a UK citizen and you open a US brokerage account and you have $1 million in there, when you're dead, you take $1 million minus the $60,000 exemption and you pay tax on that difference, the $940,000. You pay an estate tax. And the estate tax rates are huge, right? They're upwards of 40% on the assets. So this is a huge exposure for a lot of investors because right now it's super easy to open a U.S. brokerage account. The TD Ameritrade, Robinhood, all of these companies are just itching to take your money. You know, just send us the AML details so we can verify who you are, fill out a W-8 BEN, and then get started. They don't give you any education on this. They don't give you any warning. It is probably buried in the fine print somewhere, but obviously nobody ever reads that. And so this is a massive exposure for a lot of investors in the United States. And you know, what I try to do for all my clients is you can structure your investments in a way to avoid this problem. Okay, so let's go through some of these bullet points here. Section 2101, this is the part of the tax code we're looking at that assesses estate tax for non-residents. Non-residents are subject to estate tax on U.S. situs assets. U.S. property includes real estate and includes stock issued in domestic corporations. So that's if a Delaware company issues stock, you buy it on a national exchange, that's U.S. situs assets. And it also includes U.S. debt obligations issued by U.S. persons. So U.S. companies, if you borrow money directly from a U.S. resident, that's a U.S. situs asset. So think of it as, you know, any kind of investment in the United States, probably going to be a U.S. situs asset unless it's specifically exempted. Bank accounts are exempted from your U.S. taxable estate, but the big ticket items are U.S. stocks and bonds. That's where I see all of this exposure. So what happens if you die? How do you get your money out? And what are the tax issues? So when a non-resident passes away, a personal rep is appointed to manage their estate, right? So it's normally in your will. You basically appoint somebody, normally a family member, that's going to manage the affairs of your estate. So they pay all the taxes you might owe. They might consolidate your assets, sell assets, pay any expenses. That's their job. Now, if you're a non-resident and you die holding a U.S. brokerage account, your personal rep is going to reach out to them and say, hey, so-and-so died. I'm trying to get the money out because I've been appointed by the court to do so, okay? As soon as you make that phone call, the broker immediately locks the account. The assets are frozen until you complete all the required steps to pay the tax, right? So once the broker freezes the account, the personal rep now has to file a Form 706 NA, A 706 is an estate tax return. 706 NA is an estate tax return for non-residents. Okay, you file a tax return. You report the value of the U.S. situs assets, the estate, take any expenses, and then once the IRS gets the tax return and they get the taxes owed, they issue you a Form 5173, which is a clearance certificate. Until you have that clearance certificate to provide to the broker will not release any of the funds. Okay, so the clearance certificate is evidence to the broker that you've done all the filings. So let's look at this example here for John. So John's a German citizen and tax resident, and he opens a U.S. brokerage account to buy some U.S. stocks, right? The value of his portfolio hits $700,000 on the day he dies, okay? He has one son, Mark. Mark is going to inherit the account, and Mark's also his personal representative, okay? So he contacts the broker, lets him know that my father just passed away. Broker freezes the account. Mark files a 706 NA to report the gross value of the U.S. situs assets, and he's reporting $640,000. Now, why is that? Because $700,000 was the value of the account. He gets that $60,000 exemption. The difference is $640,000. Now, based on the marginal rates for an estate valued at $640,000, the taxes owed are $207,600. It's a massive amount of exposure, right? I mean, it's almost 1/3 of the account. So obviously, this is bad, right? You don't want to go down this path. So what are the solutions? There are some workarounds, right? The easiest solution I see in practice, and what I do for my clients, is we set up a foreign blocker corporation, okay? So how does that help? Your U.S. taxable estate only includes assets that are held directly in your name, okay? So if John opens a U.S. brokerage account, it's in his name. It's an individual account in his name, and he's now holding title to the stocks in there. That's U.S. taxable estate. What is not is if John opens the account through an intermediary entity. So a foreign corporation, John opens a foreign corporation, right? He owns 100% of the stock, so he can set this up either in Germany. You can do a German GmbH. If he's in the UK, you can use the UK limited company. You go with the Cayman Islands entity, Bermuda, it doesn't matter. It just has to be a foreign corporate entity. So you open a foreign corporate entity, you own 100% of the stock, and the foreign corporation is the company that opens the U.S. brokerage account. So now it's no longer an individual account open through the broker, it's a commercial account. That will help safeguard you from this estate tax issue. Because when you die now, your foreign corporation lives on, right? The foreign corporation lives on, it doesn't terminate, and that's the entity that legally has title to the U.S. assets, okay? Now, the other nice thing about that is corporate entities, you can own 100% of the company, but you can appoint other persons as officers or directors. So what John could have done in this case is, if he had a foreign corporate entity, he could have appointed his son Mark to be an officer. And so that way, when John dies, Mark and John will pass his 100% holding of the foreign corporation stock to his son, and Mark's already an officer, right? So he's already an officer, so he can reach out to the broker in the U.S. and say, "Oh, I'm the officer of this company. I want to sell the stock and take the cash and withdraw it." You can do that. Under those circumstances, the broker does not freeze the account. You don't need an estate tax return. You don't need a clearance certificate because everything is not held in John's name personally. So so that covers all the big ticket items I wanted to address for this. The takeaway here is, look, the U.S. brokers are just very freely opening accounts because they want your money, but they're not giving you a lot of education around these potential issues. So if you find yourself in a position where you already have an account, or you're thinking about opening one, and you want to avoid this nightmare of a compliance process and just the excess tax that is going to be imposed, you want to consider using a foreign corporate blocker structure to help safeguard you from these problems. So if you have any questions, please leave me a comment below. Happy to answer those. And of course, if you find yourself, in this situation and you need some assistance on how to restructure everything, please schedule a consult with me. Happy to discuss your unique facts and circumstances and see where we can help out. So, yeah, that covers it. Thank you again for watching, and hope to see you again soon. Bye.